This is an extract from actual financial statements of a company listed on the Lusaka Stock Exchange. They are listed according to the years, starting from 2014 to 2018. So if you wanted to make interpretations on this information, we would start looking at the figures one by one. So for instance, in 2014, the the revenue was 29,948, whereas in 2018 it was 421,208. So there's a huge increase in revenue from 2014 to 2018. But one thing people don't consider as financial information a lot is the ratios. And today, as we look at interpretation of financial statements, we will focus on ratios. As you can see as well, we could make decisions based on the ratios, and in fact many groups of stakeholders such as shareholders would want to make decisions based on ratios, for instance by looking at how the earnings per share is growing from year to year. And so in this video I'm going to talk about interpretation of financial statements, and instead of focusing on the financial statements themselves like we often do, so we often focus on financial statements, and this could be the statement of profit or loss, the statement of changes in equity, the statement of financial position, and even the statement of cash flows. We're not going to focus on those, we're going to focus on ratios. And there are a number of ratios that are of interest when making decisions. The list could be endless, but the main ones that we'll look at will be 5. Is it 5? Let's look at profitability ratios. Profitability ratios. We will look at liquidity ratios. Liquidity ratios. We will look at efficiency ratios. And then we'll finally look at gearing ratios. Gearing ratios. If you're new to accounting, this could be a lot to take down, but to help you remember, think of them using this mnemonic. So let's start with profitability ratios. So profitability ratios will measure the profitability of a company, like the name suggests, and there are a number of profitability ratios. The most common one, the easiest first one, is the gross profit margin, and this is calculated as gross profit. It's calculated as a percentage, so it's gross profit over sales multiplied by 100%. And everywhere you see margin, think of sales. Okay, so the next ratio, which is the net profit margin, is going to be net profit over sales times 100%. To be more specific, this net profit is net profit before interest and taxes, or earnings before interest and taxes. This is important to note because we will refer to it where we're going. The third profitability ratio that we can consider is what's called return on capital employed. Return on capital employed, or ROCE for short. Return on capital employed is calculated as earnings before interest and taxes over the capital employed. Capital employed. And this ratio is also multiplied by 100. So it's important to note here that earnings before interest and taxes is also called operating profit. So everywhere you see operating interest and taxes, and this is important especially when you're dealing with discussions in practice, and also examination questions which will just give you that terminology. We also had capital employed. Capital employed, which is this one, is just, so capital employed is just calculated as your total assets less your current liabilities. Less your current liabilities. The fourth ratio you want to look at, so we've looked at three ratios so far, but the fourth one to do with profitability, or that helps you assess your profitability, is your net assets turnover and your net assets turnover is calculated as your sales revenue divided by your capital employed. And we've looked at capital employed, and it's just on top there. We know how to calculate it. And this net assets turnover is calculated as times per annum. So if you find 2, it means 2 times per annum. If your sales over capital employed is 3, then it's 3 times per annum. And it tells us how often the capital employed, management's efficiency in generating revenue from the net assets that are employed in the business. Let's pause for a moment and look at the relationship between some of these ratios. And to check that, I want you to give me the formula for net profit margin. Net profit margin, pause, think about it, and then give it to me. So yes, we said net profit margin is equal to operating profit divided by sales revenue, right? And then give me the formula for net assets turnover. Net assets turnover is just right above here, and so we know that net assets turnover is given by sales revenue over capital employed, right? Now if you multiply these two, can you see what's going to happen? what's going to happen is that this and this will disappear, and then we are just going to end up with operating profit. So if I changed operating profit to be OP and capital employed to just be CE, we're just going to end up with OP over CE, and OP over CE is simply operating profit over capital employed. Do you know which ratio this one is? Let's go back where we're coming from. Operating profit, which we said is operating profit. Let's go back. Operating profit is just earnings before interest and taxes over capital employed. So basically what we've calculated there is return on capital employed. Return on capital employed. So basically return on capital employed can also be calculated as your net profit margin multiplied by your net assets turnover. Okay, but basically if you forget everything, just remember that profitability at least has a number of ratios, including these four that we've talked about. There's gross profit margin, net profit margin, return on capital employed, and net assets turnover. And our return on capital employed can be calculated by multiplying the net profit margin, number 2, and the net assets turnover, number 4. Let's move on to the next set of ratios, which are liquidity ratios. So you can read more about other types of ratios, but I think you would have pretty good amount of conversation with everybody with the ratios that we've talked about. We'll go to liquidity ratios now. Liquidity is composed of a number of ratios. So number 2, let's say liquidity. So liquidity has many ratios, but the ones that are of interest for me, just to get you started before you go read your books, is the what's known as the current ratio, and it's sometimes called the working capital ratio. So when you hear working capital ratio, sometimes, but the most commonly used is current ratio. What they're referring to is just your current assets over your current liabilities. Current liabilities. This ratio is important because, like every other liquidity ratio, liquidity tries to see our ability to pay our debts. It tries to see our ability to pay our debts, and the current ratio looks at if our creditors decided to come and claim their monies at this point in time, how much of our assets do we have to be able to cover our liabilities. To make it even more specific, the current ratio could, instead of calculating the current ratio, you could also calculate what's known as the quick ratio. And this ratio is also called the acid test ratio, and it's calculated as current assets over current assets minus current assets minus inventory. Inventory is just stock. Inventory divided by current liabilities. So these ratios are the most common ratios when it comes to liquidity, and they help us determine our ability to pay debts as they fall due. The next set of ratios we'll look at is the efficiency ratio or efficiency ratios, and there are a number of efficiency ratios you can look at, but I'm going to present three of them, three most commonly used efficiency ratios when analyzing financial statements or financial information. So efficiency ratios. To measure efficiency, you want to look at one, inventory turnover. Inventory turnover period is measured as your inventory divided by your cost of sales multiplied by 365 days. So it looks at how many 365 days. So it looks at the number of times you turn over your inventory, you convert your inventory using the number and it's calculated in terms of number of days. There's receivables. Receivables collection period. So to see how efficient you are in collecting your receivables, you want to calculate your receivables collection period. And this one is calculated as trade receivables. Trade receivables divided by your credit sales, and this is multiplied by 365 days. The next one you want to look at is payables payment period. So the payables payment period is calculated as your trade payables divided by your credit purchases, 365 days. So all these measure how efficient you are at as you are running your business, of course with respect to each of them separate sections that you're looking at. The next set of ratios we want to look at is what are known as gearing ratios, and I'm just going to present two major gearing ratios. So gearing ratios. So gearing looks at how much debt you have in a company and your ability to pay that debt, and that's very important because some companies have been crushed, gone into bankruptcy because of gearing. And the very first gearing ratio I want to present is the debt to equity ratio, or sometimes just written debt equity ratio, and as the name suggests, it's just debt over equity. The next ratio I want to look at is interest cover, and interest cover is calculated as your profit before interest and taxes, or earnings before interest and taxes, divided by your interest payable. and all this ratio tries to do is to see the company's ability to pay for interest using the earnings that the company has made. So these are the major ratios that I wanted to present, and these ratios are very important in helping us make financial decisions. They help. If this will help, let me just write down the benefits of ratios. Number one, ratios can help. So benefits, unlike the financial statements, they summarize a lot of information. They tend to be easy to understand. But they've also got disadvantages. There are plenty of other advantages, but some of the disadvantages are that ratios are built using financial information, and this financial information can be prone to errors. And if there are errors, say in the profit calculations, these profit calculations transfer the errors into the ratios. Another problem with ratios is that the financial statements themselves are prone to manipulation, and because of manipulation in the financial statements, manipulation could be because of what we call creative accounting. So the accountants might pass fake figures in financial statements just to show a picture that would be favorable to them, and these manipulations might also not appear in the ratios, so you might not be able to see issues. Another problem with ratios is that there is a summary. While that's an advantage, this means that a lot of information is lost somehow. So this is a summary of ratio analysis. I was just trying to give a brief overview, but I hope you've gained something. In one of the videos, I hope to do 1 or 2 examples on ratio analysis. See you there.